Thank you everybody for joining us, and those of you joining us on the recording as well. We'd like to welcome you to our event today. We have a great session about sweat equity for early stage companies with Jameson and David from Lynx Ventures. I just want to remind anybody in the audience currently with us, if you have a question, please drop it in the chat box and we'll get to it when we can. And with that, I'm going to pass it over to these guys to get things going.
Awesome. Thank you so much, Shane. Give me just a second for that age-old process of sharing my screen. Okay, yeah, thank you for joining us today, everybody. Today we're going to be talking about sweat equity investing for early stage venture. Take your questions about the best way to structure, the best practices, where to find sweat deals, how to do sweat deals. First, we've got a few slides to go through with just some of the benefits of sweat investing, why you should consider it, and particularly we think this is a timely conversation. This is the right investing strategy for the macro environment right now. So with that, we'll kick off into a little bit of content. Please, like Shane said, drop your questions. We'll look out for them here as we go and try to tackle them as we go. And of course, there'll be time for more questions at the end. Before we get much further into it, I'll just spend a minute to explain who we are. So Lynx is a sweat equity investing network. The management team is myself and David joining here today, as well as our in-house counsel, Nima Amini. Just a bit on my background, what brings me to sweat equity. So before this business, before this group, I lived this problem that we're trying to solve. I started, ran and sold a marketing agency here in Austin that did growth, product marketing, but particularly worked with early and growth stage businesses. And I was, as the operator of that business, working with those clients, I wanted venture exposure, right? In solving that problem, looking for the best way to structure those deals, we ended up founding Lynx, putting this group together. Today, we put together this management team, as well as a great group of venture advisors. But most importantly, we've developed a roster of just about 50 partners. So we're kind of like a funny-looking venture shop, where instead of our partners being investors, they're all service providers. So they're all shops, marketing agencies, PR agencies, development, app development, engineering companies, law firms, lots of law firms, recruiting companies. So all of our partners are service providers on one end, and on the other end, we look to identify startups to invest services into, right? So invest sweat into instead of cash or alongside cash. So that's what brings us here today to talk to you all about sweat equity. Anything you want to add, David?
No, good.
Before we get into sweat, we want to spend a minute just about the way that we view the status quo, current traditional early stage venture deals, and sort of how we can build on that from there.
So despite venture being the vehicle to fund innovation and companies to do that, there's actually been very little innovation in venture itself. It's about a century old, and there's been very little progress or changes as that's moved along. And there's sort of a chicken and the egg problem when you go and raise money, right? You need to be able to demonstrate traction and growth with companies to get that funding, and then investors want to see that before they put capital in. And so you need either your own capital or your own services to go ahead and execute that vision to a point that you would get investment. So we're trying to kind of cut into that cycle and make that easier and lower those barriers to entry.
So we've thought a lot about the safe notes in our time doing sweat deals. There's a lot to love about the safe notes. It came out of Y Combinator just about 10 years ago, I think in 2012, between 2011 and 2013, but it's just about 10 years old. And it did so many things right, So it's a form of convertible debt, purpose built for early stage venture investing. It's a standardized document. It's a short document, which is so powerful. Generally, founders and investors agree it's fair, right? So it took this one problem of valuing an invaluable asset like an early stage or pre-anything, pre-seed, pre-revenue, pre-product company, right? It solved that problem, and it boiled it down to these terms that we live with every day, right? In venture now, valuation cap, valuation discount, and best of all, right? The very name of the thing, simple agreement for future equity, a safe note, creates confidence in it, right? So it reduced friction in early stage fundraising and unlocked a ton of capital in the very earliest stages of venture. So that's everything that it does well. However, right, in solving this fundraising problem, the SAFE didn't address some other problems, and it also created a host of problems, right? So the best case scenario, if you are an entrepreneur, you raise a SAFE round, your fundraising problem now becomes a recruiting problem, right? And the basic startup economics are, you have a pile of cash, either big or small, you have some amount of proceeds from a raise, and you do this calculation, right? Who are you going to hire? How much is the burn? Proceeds divided by burn equals runway. And now I have this block. I have this challenge, right? As a startup organization, I am seeking product market fit. I am seeking a performant business model, and I have this amount of runway to either identify it, identify that model, or raise again. And so we just, turns out, right? Like surprise is that most founding teams, most startup organizations that raise on a SAFE can't do it, and not just even the majority, but the vast majority, right? There's this kind of embarrassing statistic of our industry of venture off-cited. One of 10 startups make it from a SAFE round to some type of exit. And these innovations, right, these tools like the SAFE note from Y Combinator, they haven't improved those results at all, even though there's been just constant increase, albeit this year is rocky, right? But a consistent increase in venture funding. The rates of success of startups have not improved at all. So this is kind of our view on like the status quo of early stage venture, and how we start to really evaluate sweat deals within this context.
So we have written a white paper to kind of go into a little more detail on kind of what James spoke on, and sort of the journey from venture capital, starting with the family trusts and way back in the Industrial Revolution, and then funding the original products, and then sort of World War II era, when the common venture capital situation environment that we see today was kind of born. And we present the journey from ARDC and the Fairchild Act, and sort of like the transition from the power and negotiation from early days when it's all investor power, and these negotiations sort of take it or leave it, very few sources of capital, extremely high barriers to entry, and then kind of, as James touched on, the SAFE note and the progression to allow easier flow of capital, reduce some of the problems and friction, and put more power in the founders' corner for negotiation.
So, all right. So we talked a little bit about investing on instruments like SAFE notes in the early stage, and some of the shortcomings of that, or the problems that it might create for founding teams. So we're going to spend a few minutes talking about the benefits of kind of what we're coining sweat investing, but basically why we should all of those of us working in venture, either entrepreneurs founding businesses, investors investing in businesses, the talent that works in those businesses, why we should consider sweat equity as a part of that, and then we'll get on to sort of how to do that. But first, to just touch on the benefits there.
So first and foremost, like the most important aspect of sweat equity, and sort of the vision of our company and our motto, is that aligned interests create better results. So having your, expanding your team from just your internal hires and changing the dynamic between you and your service providers is huge, and should really increase that 1 in 10 success rate. So you want to adjust sort of the thought process of your service providers from cash in the door today to what you're thinking about, which is the long-term value of your company and the success in executing your vision. So, historically, founders have been limited by cash constraints when choosing their team. You kind of have this balancing act between what you really need to execute your vision and what you actually can afford. That's really tough. It's one of the biggest problems founders face, especially going through these early stage processes when fundraising is really tight, especially in a macro environment like today. And then the second component that we think is great about the sweat equity is it allows people to go ahead and bring teams in instead of individuals, which is, there's a different value add possible from a firm over a person. And sweat equity allows founders to preserve their two most important assets, which is time and capital. Increasing run rate is, obviously huge and allows you longer time to execute your vision, better time for traction, better time for growth, and a higher likelihood of success for having more time, having everyone invested in the long-term vision of your company, and a higher quality of partners as far as who you can get to work for you. It's sort of the vision we see for founders and the benefit for them. We provide some best practices that kind of help these founders negotiate and look what terms make sense for them and what structure the deals can get them to get these best partners.
Yeah. I just say in short for any entrepreneurs, founders in the audience, the benefits as you're raising, thinking about your team, the benefits for compensating your team with equity are huge, right? You can raise less cash to begin with. You can extend the cash that you do have for longer runway, and the team that you will be able to hire will be higher quality, and they'll be aligned. They'll be bought in on your vision.
And then just one other point is that this allows vendors to go above and beyond and do value add when they see the potential to do so, which doesn't really make sense in a normal deal as far as them, like they can't really commit hours over the normal engagement. And this kind of gives them the freedom to be like, hey, we see an opportunity to create more value. We can go and do that because we are compensated for that.
Good question about how we, I think I'll come back to this one about what's the fee for startup. We'll talk about how we often structure venture sweat deals so that it makes sense for all parties. I see that one there. Thank you for that question. As the, not again, let's see. Come on. Don't do it to me.
Click out.
Don't do it to me. So this is my core empathy with sweat equity investing is as one of those service providers, right? So, having been the guy that was hired by, a dozen kind of Series A stage companies to do the marketing, right? I wanted a piece of it, right? So, the core benefit to service provider, so looking at the other side, so the talent that a founding team will hire, right, is that their incentives are for the long-term success of the business as opposed to extracting cash, right? So alternatively, if I'm any one of these people, right, if I'm an app developer, a marketing agency, a law firm, right, and I'm looking at an early stage company that just raised on a safe round, like actuarially, right, they're not going to be around in a couple of years, right? So my incentives are out of whack if I'm compensated with cash, right? I'm incentivized. Of course, I want to see them succeed. I want a long-term account, but it's not as good as if I had the opportunity for upside or for equity in there. We also find lots of the partners in our group, they use this as a strategy to price to startups, right? So if you work with businesses of a variety of levels of maturity, maybe enterprise end of businesses, you can charge a cash rate for one rate, whereas this is a way to price to earlier stage companies in a way that still captures your full value, but is it a cash rate that's palatable to people only raised 6 or 7 figures of funding. And most, I think very interesting, we have a couple of our partners who view taking equity compensation in their engagements with early and growth stage companies as kind of like a counter-inflationary strategy, right? So like we're talking with law firms and PR agencies who would usually at this time of year be looking at kind of some type of year-over-year rate increase, right? To keep their average their average blended rate high enough for them to, give all of their folks a pay bump to account for, the whole inflationary cycle, right? But one alternative that they're looking at is, instead of just charging more, right, increasing their cash rate, they look to include in their engagement a portion that is to, capture some equity upside, right? So, and then lastly, and maybe most important, and kind of, where I come from on this issue is, this gives service providers exposure to a venture portfolio that they have influence over, right? So, compared to the next angel investor that manages some small venture portfolio, and you get cash and you get updates, and maybe talk to the founders. This is a different level, right? It's a way to kind of bet on yourself, right? And actually have some, not complete, but some influence over the future valuation, the future likelihood of success of that company compared to, venture portfolio.
So just real quick to add to that, the ability to compensate your employees, we think, is also a huge perk here. There's, if you are a service provider, it doesn't really make sense to compensate your employees with some stock options, as they didn't really build the business that you're working on, and they work in very short or project-based situations. So being able to utilize sweat equity to give your employees compensation in the deals that they work on, especially those that you're driving value, and you're taking this company from a seed to a Series A, and there's a bunch of potential to increase valuation. Giving your employees a chance to share in that is huge as well. So investors is interesting. The benefit to investors, we had some feedback that people were a little concerned that it's kind of cannibalizing the ecosystem, it's competition. But the way that we look at it is, this is a huge help to investors, and if we're successful here, we're able to build a de-risked and safer investing, smoother transition, sort of being able to see a better look at the playing field. So sort of the initial ROI catch is that when you invest in a company, they are going to go spend 2/3 of that money on external service providers who are marking up their services, conservatively 30%, could be double, could be 3 times. So you're losing that money to the markup on that instantly, which erodes your ROI. And then sort of another benefit is that you've de-risked the situation, and when you look at investing at these companies, you see, okay, I'm paying for the internal aspect, but the potential for me to look and see, okay, the product team is handling this aspect. I know this product team, they're great. The marketing team, here's all the engagements that are done, and all these people are bought in, which kind of brings us to the last point that, you are handing out diligence and outsourcing it to people who are subject matter experts. Like, the marketing team is going to know, when $1 into marketing is going to drive additional value. The product team is going to know when a certain product is going to have product market fit. And to that end, it's difficult as an investor to be an expert in all these fields, and you're kind of just judging the team, especially in an early stage. It's kind of like team and gut almost. So being able to outsource to people who work in these fields every day is a huge benefit, and should increase that chance of success, and that flows through the ROI as well.
Yeah. So in addition to, I think there's immediate benefits for kind of these 3 groups, including sweat deals in early stage venture fundraising to founders, service providers, and investors. But I think there's I'm gonna spend a minute on like a host of kind of secondary effects, right? And so overall, our pitch here is right. This is why everyone should have an eye towards sweat, toward basically the way that you compensate the people involved in a project with equity in that project. The first one I would point out is that sweat equity, bringing in the right people, is a huge value, right? So from the investor point of view, we have these meetings all the time, right? Every investor, claims to be more than a check in the mail, and offer this additional value, guidance, or support, right? In my experience, what actually gets product shipped, right? What actually gets users in the app and not falling out the other end, or it actually gets the major enterprise partnerships that move the needle, or not just that first check, but wrapping that team in the best people, right, in the best services or talent to succeed and make it to the next level, right? So if you are an investor and you're evaluating an early stage venture deal, right, like our suggestion to you is have an eye toward the sweat deals that will, surround it, right? And if you can bring that in and offer that connection to the founder, it's huge added value. Not to mention, a performance boon for your portfolio. Our second point here is we think there's a huge advantage to structuring the round itself around a mix of cash and sweat, right? So the example here would be like looking at a round for, I don't know, a couple of $1 million or something like that, a seed round, and then looking into the use of proceeds and identifying what amount of that raise will go through what different types of vendors, of different types of services, or what team members. And then from there, working backwards, right? Identifying who those vendors are, who are really the best people to execute this thing, and how much might they be willing to sweat into the project, right? Which can itself close some of that round, reduce that fundraise there. But this process that I just described, right, is uncommon, right? It is usually like we have to raise this much money because, right? And so going through this thought exercise of identifying the team from the very outset and having those conversations will be, it's natural selection for sophisticated teams. And as they're kind of funded, locking in the people who will take it to the next level, as opposed to first getting funded and then deploying funds, right? And then lastly, this is kind of my soapbox point here would be that this venture is itself a tool for innovation, right? For creating wealth, for improving quality of life, for advancing technology, right? And it's terribly inefficient, right? Like we are deploying capital to organizations that fail at spectacular rates, right? And so if we can improve that and do leaner deals with better teams and improve the efficiency of the whole industry, right? Like that'll have massive positive effects on the economy, the venture industry at large. This is a good question here. What are some good examples of companies you've seen be successful with sweat equity? I would point toward again, I think the savviest use isn't like I can't raise any capital, so I'm going to go get a sweat deal and hope it works out. But the founders who are thinking about it as a mix, right? Like this is the amount of cash I need to raise for these expenses. This is the game plan. This is the team that I can bring in to do this, and I want them to be bought in. So we're going to work out a deal where they're paid some cash, but a lot of equity, things like that. They're thinking about it really savvy. We think particularly there's a benefit to identifying some of the riskiest line items on a use of proceeds and filling those with sweat, right? So if a business is super legally intensive, right? Can you identify the best law firm for that problem, right? If it requires whatever it is, I'm imagining some companies that we've worked with that are doing interesting things in like secondary markets, secondary sales, private equity, like extremely legally intensive, but hugely disruptive concepts, right? And so a way to de-risk that, scale that is, in this case, making sure you're wrapping like the best legal mind on solving that problem there on that innovation. Likewise, if a business is a startup success relies on marketing, on user growth, right? Like if that is key to all of the projections and everything working, right? Like, can we identify the best marketing team to do that and get them bought in at a rate that works for everyone from advance, in advance, the way that we kind of counsel like service providers to think about it from their end, right? And so their point of view is almost as an angel investor placing services instead of cash in the business is, will this business be responsive to the investment of our service? If I invest $1 of marketing services or $1 of legal work or an hour of legal work, $1 of legal work is a really silly thing to say, right? Will it return, greater than $1 in like the future valuation of that company. So those are the best examples when you're using this as like a really savvy tool to do the best venture deal that you can do.
I would also add that, probably not driving the most value, but one of these sort of like first cornerstone things that's, pretty funny is the Facebook person who painted a mural took equity instead of cash and ended up being tens of millions of dollars, right? It's not really, driving value, obviously, but it kind of shows the benefit and upside. But yeah, as Jameson said, really trying to find like what is the core thing that we need in this business, especially if it's not your area of expertise. For example, we did a $250,000 sweat deal with Amini Conant, a law firm here in town, because neither Jameson and I are a lawyer. And, with the product and facilitating these sweat deals, there is a ton of legal work that needs to be figured out, especially trying to create sort of a frictionless way to facilitate these deals in an easy plug and play method. There's a lot of things that need to be thought out and considered from a legal aspect. So, outsourcing that to a really good legal firm is super helpful for us.
I have a question about liquidity. You want to take that one now?
Yeah. So, we'll touch.
The question is, do service providers have to wait until an exit to get paid?
So we'll touch on this a little bit more in the marketplace, but the way that we facilitate these deals is through SPVs, which allows you to create a secondary market and sell shares in the SPV as opposed to selling shares in the company. So to do that, right, like a great example is your marketing firm that you hire as a seed company, and you drive a bunch of value. They raise a Series A, and then they start bringing a team in-house, and you are like no longer driving that value. You're no longer really part of the company, but you did a great job and you drove that value. It doesn't really make sense for you to sit and hold for 7 years until exit. Sort of the best strategy would be to take that money out and recycle it into another deal. So we are using these SPVs to create a secondary exchange, which will be on the marketplace, and hopefully facilitate deals at a decent rate and not have a liquidity crunch that lowers those prices.
All right, tell me where it's ended. How do I advance the slide?
I think you just
without the Zoom freak out. Wow. All right. Okay. So, this is our pitch. Our pitch is basically savvy investors, savvy founders, savvy service providers have their eye toward a portion of equity compensation in early stage venture deals. Now we'll spend a few minutes talking about like our advice on how to actually do a deal like this, how to make sweat equity work for you. So my first kind of thesis is that like a service provider coming in at the early stage of a startup company is in many ways like any other angel investor. They're this kind of special type of angel investor that can provide all the benefits that we talked about earlier. But these types of sweat deals can be done on instruments very similar to the instruments that early stage venture deals are already done on and thought about the same way, rolled into all of the same terms, conversion, et cetera. For example, the deals that we do with the partners in our network, we do on an instrument that we call the sweat note. And the sweat note is sort of let's see, do I have a slide on this, guys? A spiritual successor to the safe note. So it's this special type of convertible debt, pre-priced instrument, but it's written for purpose for a service provider to use, right? And our advice in structuring a sweat deal is just like the safe boils down this complex fundraising event into a couple of terms that have taken over the industry. Is that sweat deals at the early stage can be negotiated on the same terms, the same safe terms of valuation discount, the valuation cap, plus a couple of other terms, right? So like I was getting at earlier and talking about the round and the use of proceeds from that round as a whole and the budget for that. The primary term that we encourage all sides of the deal to think about is what we call the sweat rate, but basically what percentage of a contract will be paid in cash versus paid in equity, right? And we see a whole range of this happen in actuality, right? Very commonly, for example, lots of the dev shops in our group will offer 50-50 deals, right? So they will develop an application for an early stage company, a mobile app for an early stage company for half of the engagement in cash and half of the engagement in equity, in this case in future equity, like the safe note there. But together with these, if you're negotiating on these handful of terms, you can include sweat, you can include service providers as an investor in your round, from either side, on those same terms there. So this is an easy way to get started with sweat equity from either side, and we encourage, like, even if it's not a tremendously meaningful amount of capital, in the same way that you would incentivize senior hire, right? You would see anything, right? Head of product, CFO, see any senior role in an organization with some type of equity compensation, whatever it makes sense, right? Grant or option, or the structure of that company. It makes similar sense to incentivize your vendors, service providers, that same way. Maybe I'd say we see as little as 10% of these contracts paid in equity, and we see as much as the entire contract paid in equity, and the service provider throwing in cash as well, right? So we see the full range there, but by using these, breaking it down to these terms, you can find a deal that works for everyone. This point, David already got to here, right? So the tools of modern venture, right? Like SPVs and these emerging strategies for selling on secondary markets throughout the life cycle of the business. They're just as, if not more, applicable here, right? So we find that your average service provider, so let's say your 50-person dev shop that specializes in making the fintech app that you need to make, right? Mr. Founder or Ms. Founder, right? They may not have the same tolerance for the duration of an investment that a VC does, or that an angel investor does, right? Who might be able to sit and wait, put their capital to work and sit and wait for 7 years. So, using these deal structures can make it possible for this service provider who may need access to the capital sooner, maybe, at a later VC, later stage round, but not you're waiting to go public, make that available. And that's a good thing, because in the beginning, it gets you access to better talent.
Yeah, so yeah, minus the chat down.
Have any question?
Yeah.
David, I see your note there. We'll reach out to you after the event there. I don't know if I fully tackled, looking back at questions here, this fee question. So I think, that the answer to that is do you want to talk about the structure of the sweat note more?
Oh yeah, we can do it on the platform.
Okay, cool. All right.
So kind of using what Jameson has just described, the sweat note as sort of the cornerstone, we have this grand vision of creating this ecosystem for startups to exist when they create a business, and have this sort of frictionless, easiest way to have everything that you need to start a business. And we want to make this sweat equity deal process as simple, as transparent as possible. And carry throughout the life cycle of the deal, from origination to exit through the secondary market. And this starts with deal origination. As we mentioned earlier, we have about 50 service providers that are industry best, sort of willing to work for sweat equity. And the process of startups kind of coming in and putting in bids for services, and then the vendors kind of coming to them and letting them know sort of their core competencies, describing their unique value adds, as well as kind of outlining the terms that they're willing to work for. And we kind of provide some materials to do some best practices and help people evaluate what makes the most sense for them. And the way that we're structured is we take a cut of the sweat equity that is generated, Our whole thought process is that we want to make this as frictionless as possible and benefit when we create value, which is what we believe the sweat equity will do. So founders will not pay anything; they just get to request services, and then we take a cut of the deal when it's vested. So, and then sort of the second component here of the dashboard of the platform is a dashboard that shows easy tracking of all your deals, kind of where you are in investing process, invoice management, and then sort of the coolest thing that we are really excited about is the valuation to allow users to toggle through a few different methods to see what their equity is worth and where they stand as far as what revenue they're bringing in. And using a bunch of different methods to do this, allowing people to kind of take it into their own hands, such as, the last valuation round is sort of the baseline, and then allowing people to toggle through metrics based on like industry multiples on sales and revenue, et cetera. And just making it a really exciting process to go in and feel like you have, gone from just doing your normal hourly work into, creating real value and wealth and being a part of the success that you're helping create. And to add, we want to share in that value and that success. So yeah, I think that is all on our end, Shane.
Yeah, great. Just a reminder to anybody in the audience, we do have our chat box working. So if you have any questions at the end here, we have a little bit more time. My question was, I know somebody asked earlier about examples of companies that you've seen be successful with sweat equity. So I was just wondering on the other side of that, basically, are there examples of companies who you don't think would benefit from that? Just for some of the entrepreneurs that are watching this, I think that could be helpful.
So on the vendor side, there's sort of the lower end of startups that, if you don't have any money and you can only do equity, there is a chance that it's, a lower quality and won't turn into a successful investment. From the founder side, if you have someone on your team that you think can create this value and do this project, you may not want to go ahead and create a sweat equity deal with someone else and sort of duplicate the efforts of your team. But yeah, using the use of proceeds is sort of the best tool. And like, if you are, under 2.5%, 5% of your use of proceeds going to something, it might not make sense to go through this process and have this person as an investor. But using sort of a rule of thumb is 5% or 10% of your use of proceeds or greater can help you kind of evaluate when it makes the most sense. And we have some best practice materials kind of outline that and help people come to that decision. You have a
All right. Yeah, I would just say there's like not every investor deal is a good deal. Not every sweat deal is a good deal, right? It requires nuance. Encourage like founding team in particular to think about what services are you going to kind of hire for versus vendorize? What does that make sense based on your vertical and like what are the really risky parts? And then within that, what are you going to raise versus what can you sweat? So I'd say that the examples of deals not to do are just the ones that have not been well thought through, right? Like just our advice is not just get you flash into there and work for any company for equity. It is if you are a sophisticated operator on either side, there are returns to be made. There's a higher likelihood of success if the people involved in these venture deals are looking ahead to where is the money going and how can we properly incentivize those people in this same deal. Question here for is the access to sweat note only for people on your platform? I would just say we didn't invent sweat equity. My point of view on this is that the more eye toward sweat in early stage venture, the better the entire industry will do. We did make some tools to try to make it easier because that was our background, trying to do better deals. So yeah, encourage you to reach out to us for copy access to any of the free tools that we have available.
Awesome. Yeah. And we're going to connect everybody after this. We'll send the follow-up, the recording and all that good stuff. But if there aren't any more questions, I'd like to thank you guys for coming out and educating us a little bit more on sweat equity and telling us more about what you guys do as well. We'll be sending the recording, like I said, to everybody tomorrow. Anybody who's watching the recorded version of this, please feel free to send in your questions and we can get those answered as well. If you'd like to just see more of our events coming up, you can hit us up on our event page on Eventbrite. And, as always, reach out if you think 10 Capital might be able to help you raise funding for your startup. So again, I want to thank you guys. Is there anything else you want to add here?
Thanks so much for having us, Shane. Maybe we can, I know we mentioned several resources that we had linked here. Maybe we can give you those links so it can go out in that kind of post-event recap there. So make that available to everyone.
Yeah, that would be great. Well, with that, I'd like to just close out the room here. And once again, thank you guys for joining us. It was a great session.
Thanks, everyone. Appreciate
Thanks,
you taking
everyone
time.
for coming. Appreciate you.